One of my favorite types of savings account is the regular saver or the monthly saver, but they're often quite misunderstood. And more often than not, I'm seeing comments from you guys going, hang on, this is a con, this is a rip-off. I'm not getting that rate of interest that I'm promised. Well, I can assure you that you do. So what I want to do is just take you through exactly how they work and a few hacks to maybe maximize your use of them. So let's kick things off. What is a regular or monthly saver? Well, it's in the name. The idea is you save on a regular basis, which is pretty much always monthly. And the idea is, yeah, you get paid, you move that money into this account, and it gets you into that habit, which is a fantastic way, I think, to be saving. And in return, these accounts have often, not always, a much, much higher interest rate than you're going to see anywhere else. Again, big reason why I love them. So you're saving regularly, you're getting into a habit, and you're getting a higher rate of interest. Perfect, okay. There are some restrictions, though, that come with this. You can't really put a lump sum in. They're only going to be, again, for that smallish amount every month. And I say smallish, it could be quite sizable if you're doing it on a new money you're saving every month. Often they range between a maximum of 50 quid and 500 quid. You're more likely to see them around that 250, 300 quid mark, but there are some obviously at that smaller end, some at that slightly higher end. I don't think I've ever seen a regular saver with more than 500, and that in itself is quite a rare one to go for. And some of them also require you to save something every single month. So you might have to put just a quid in, or maybe 30 quid, something like that, not too much, but some of them can let you miss a month as well. But that's the idea. You keep saving with them. The other restrictions, though, are worth knowing about too. One of them is that on the whole, though not always, these accounts last for 12 months, just for 1 year. And at the end of the year, that's when the interest is all paid. And then it closes down. Now, some of them might auto-renew and start a brand new regular saver. Some of them might require you to activate a new one to keep this process going. Now, that's not necessarily a bad thing, but it obviously does mean that that rate is only going to last for that duration. And that money then, that lump sum that you've got plus that interest, well, you're not going to be able to get that same rate. You have to move it into an easy access or a fix or whatever it might be in order to earn interest on it, and then small amounts again, whatever is the cap of the regular saver you have month after month after month. Not all of them do that. There are a few exceptions, I say. The notable one there are the NatWest and RBS digital regular savers, which keep going month after month, year after year, but they have a different kind of cap. And this is a cap of how much money you can earn interest on. So that one has a total cap at the time of recording this of £5,000. That amount has changed over the years, but broadly speaking, then when you get to £5,000, well, you can't add any more money to it and get that high rate of interest. But most of them do work the other way, and it's set on a year. Some of them might even be less than that. Some of them might be as little as 6 months, 3 months. Again, some could be 2 years, but that's broadly, they all work mainly in the same way. Something else that's worth knowing about these accounts is, and again, it will vary from account to account, is some of them do not let you access the money. The majority of them don't, although more and more now we are seeing ones which are easy access. But if they don't allow any withdrawals, that means the money you're putting away is locked away for the duration of that year, potentially. If they do allow withdrawals, then it's worth checking to see whether they're flexible. And what that means is if, let's say, the maximum you could put in every month was £200, if you added that full £200 but took 50 quid out, could you then add in back that 50 quid to get back up to that £200 cap of new additions every month? Or is it, no, sorry, you've taken money out, and that obviously, whichever one it goes for could change how much interest you get over the year. Now, I generally don't treat these as easy access accounts. I like to have my easy access money in a separate easy access savings account, but they can be a good medium. So if you hopefully don't need to access it, but if an emergency comes along, you can get it, that's not a bad thing at all, because again, you're getting that higher rate of interest and you're getting that habit of saving every single month. Interestingly as well with these accounts, the rates vary in terms of, are they variable or are they fixed? Now, you guys know this already, but a variable rate means the bank could change the rate during the term of that regular saver. So halfway through, they might go, this is no longer paying 7%, is now paying 5%. If it's variable, they can do that. But if it's fixed, you are locked in. That money is guaranteed to be paying you for the duration of that, whatever that regular saver lasts for, guaranteed to get that high rate. And I'm a big, big fan of that, particularly in the climate we are right now, where we are seeing the start of interest rates being cut by the Bank of England. That's likely to continue over the coming years. If you get in while it's fixed at that high rate, means you are going to get it for the duration. Of course, when it matures, then if it has cut in the meantime, you open up a new one, it will be at that lower rate. But even so, I'm a big fan of going for those fixed ones over the variable ones, unless there is a particularly amazing higher rate available. The other thing that's worth knowing about with these regular savers is not all, but some of the best ones, in fact, most of the best ones, do require you to have a current account with the bank, or in the case of some building societies, to have been a member of that building society maybe 6 months before or a year before. It varies depending on the account. Now, you can't do anything really about those regular savers that require you to have an existing account more than a year ago, except from perhaps anticipate if one of those ones comes back, and maybe opening up, put £1 in a savings account with those building societies just in case an account comes along. So you're not really losing out much, but you've got the opportunity if it does arise. But the ones that require a current account, well, you could just open a current account with those banks. You do have to bear in mind here, of course, that when you do open up a new current account, the vast majority of cases, particularly the ones which have the regular savers, you will be credit checked. There'll be a hard search on your credit report. Now, it's no bad thing. In most cases, very, very small impact on that, and it will rectify itself after a few months. But if you do have something important coming along, like a mortgage application, you might want to avoid doing this at least 6 months before that mortgage application comes across. And the other thing you do need to think about with these banks that require you to open up a current account if you don't have it already is, would you be doing yourself out of a bank switching offer at a later date? A good example here is First Direct. Now, their bank switching deals come and go, but their regular saver is always one of the best ones out there. So let's say you apply for this when there isn't a switching deal. You open up that regular saver, you're saving a decent amount of money every month, getting a high interest rate for a year, fantastic. If a switching deal comes back, you'll sadly be ruled out because you won't be able to get it as an existing customer. So that's something to bear in mind there. Other banks might work differently. Again, we've covered in detail all the different banking switch offers, past and present, and you can go to becleverwithyourcash.com, look at all the previous switching deals, and although things can change, there's no guarantee, look at the last one that ran and see if there was a condition that would rule you out of getting that switching bonus if you've already opened an account. So that's something just to think about there. But broadly speaking, those ones, having a current account is not really a block unless you're waiting for that. So far, pretty straightforward, right? You save every month. You get a high rate of interest, 6-7% potentially, maybe more. There are maybe a few restrictions in terms of how much you can put in every month and how much you can access it. But also potentially, you might have to have a current account or an existing relationship with a building society to get it, okay? So where's the controversy come from? Well, it comes down to the interest you actually get at the end of the year. I'll make things simple here. We'll take an example here of a regular saver that say pays 5%, and you can save up to 250 quid a month into that account. Now, let's say you do that. You put that for maximum 250 in for a year, which means after a year, you've got £3,000 that you've added to this account. Now, if the interest rate is 5%, and this is where people get quite confused, they will go 5% of 3 grand is 150 quid. Okay, that's what they would expect to be getting at the end. But in reality, it's going to be less than this. It's going to be roughly half of this, actually. And this is because you only earn the interest on the money for the time it's in the account. So let's say we start with month 1. You put 250 quid into the account. That will be there for the full 12 months. But in month 2, you put the same 250 quid in. Well, you've already missed a month of that year of the account, haven't you? It's only going to be there for 11 months, which basically means it's going to have a little bit less interest on that section of 250 quid. Month 3, it's only going to be in there for 10 months. So again, that particular 250 quid is not going to be there earning 5% for 12 months. It's only earning it for 10 months, and so on as you go through to that final month, month 12 of having the regular saver. You put the cash in, it's only going to be there for a month earning that high rate. So that's how it balances out. So yes, you are getting that high rate of saving on the money when it is in the account. And if it is a high paying account, better than anywhere elsewhere, that's still better than your other options. But it doesn't mean you get that on the final balance. And this is where people get confused. I think once you understand it, you realize, oh, okay, right, these are actually pretty good. There is a shorthand if you want to just trying to get a sense of actually what am I going to get. And it's not 100% this, but it's roughly dividing it by 2. So this example here we've got of that £3,000 over a year earning 5%, you actually get £81 rather than that total we said before of 150. So Yeah, not quite 50%, is it? But if you did that, you divide, it's actually 2.7% on the lump sum. So roughly divide it by two, add a little smidgen on top of that. And that's how you know really what you're going to get if you put the full amount in every month. There are calculators out there online. Just Google them. Money Saving Expert has a pretty decent one, which give you a more accurate amount. Now, I'm not going to go through all the different accounts with you right now, simply because they change all the time. But we have got a list over at becleverwithyourcash.com/savings. And actually, that's just got the top ones. We've got a separate page as well you can click to from there, which takes you even more different regular saver options out there. Ones which you have to have a current account for, ones which you don't have to have any relationship with. You just open up ones which are fixed, ones which are variable, ones which have small amounts, ones which have large amounts, a whole selection for you to go from, but the top paying ones out there. All the ones which are going to pay you much more than you're going to get easy access or fixes or notice accounts. I also want to quickly talk though about some hacks to maybe kind of boost your return on regular saver. Some of these might be relatively obvious, but they're useful to share with you. The first one here is you aren't restricted to just one. You can have a number of these. So yeah, I've currently got 4 or 5 different regular savers, getting those high rates of interest, and I'm just adding new money every month. But I'm also, and this is the second hack here, drip feeding into those regular savers. And this is effectively where I've got money sitting in a separate easy access account and funneling that through. Because obviously, if you have a number of these regular savers, well, you know, unless I put all my salary into it every single month, then I would be pretty much wouldn't have anything left elsewhere. So some of my normal savings, new savings every month goes to the regular savers, but I'm also drip feeding stuff across. I have covered that in more detail, so do check that out if you are interested in that. Very quickly, I just want to talk about how you can maximize these different regular savers as well, because the important thing to know here is you are not restricted to just one regular saver. Yes, you might be by that provider. They might only let you have that, but there's no reason why you can't have a regular saver at First Direct and at NatWest and at Nationwide and at Club Lloyds and at, you know, the list goes on. Obviously, you're only going to have a certain amount of new cash that you can save every single month. It depends on your earnings and your outgoings, but broadly speaking, you know, one of them's got, they've got, let's say on average, those 4 or 5 accounts I just mentioned came up to £1,200 you could put in. Well, that's a lot, isn't it? Coming out every single month to be pushing in of new cash. You need that to pay bills and so on. But that could be useful to have a larger number of these regular savers if you want to drip feed them from another account where you do have a lump sum. Because remember, you can't add these big chunks of cash straight into a regular saver, but you can, over time, funneling that money across to get those higher rates. And that means you're earning money on that easy access account while it's sitting there at a decent rate, but then also getting hopefully a higher rate when you move it into that regular saver. And at the end of the year, move all that lump sum again back into your easy access account and start that process again. So they're good for new money and they can be good for drip feeding as well. All I would say about drip feeding though is also do have a look. If this is money you don't need to access at all, you can lock it away. Do have a look at any fixed rate accounts and just see what you would get over the year. Because again, we talked there about dividing a rate by 2. So let's say the rate is 7%. So roughly that means on that lump sum, you'd get 3.5% over a year. Plus the drip feeding method would probably boost that up a little bit. Let's say it boosts it up by another 0.5%, even 1%. But if you can also get a fixed rate account at 5% for that lump sum for a year, again, just using arbitrary figures here because we know things are changing so much right now, well, it's just going to be easier to whack it in the fix. But as we see rate cuts happen this year, if that difference is enough, if the easy access accounts are similar enough to the fixed rate accounts, then this drip feeding thing will earn you more money as the year goes on. Remember, you can find the best rates for all the different accounts over at becleverwithyourcash.com/savings. My name's Andy Webb. Thanks so much for watching. Until next time, cheers.